I'm here to teach you how to trade and understand the market. I did it under a year, and I'm still in high school, so you could do it too. And if you don't think I'm credible, go to my YouTube channel. I documented the entire journey, so you could go watch. Anyway, actually getting into the video now. So, with this mini part series I am doing, I do not want you guys to feel like you have to understand everything in this video, in the first video. No, we will go in depth of every single topic. So for now, let's just get straight into it and take notes or don't take notes or listen or do whatever the case is. So there are a few vocabulary terms you are going to have to know if you do not know what trading is. This is more so for my beginner to intermediate traders. You're going to learn something throughout the course. And if you're profitable, you shouldn't be watching the video. Go click off, go do something with your life that's not watching the video, unless you want to. So, now finally getting into it. The first thing you're going to have to understand, if you do not know what Forex is, you're going to have to understand what a Forex pair is, what the foreign exchange market is. There are going to be timestamps, so skip around if you need to, or don't skip around and just watch the entire thing. First off, if you do not understand what the foreign exchange market is, it is simply two currencies bidding against one another. If I could say it to a fifth grader, currency versus currency. That's it. Personally, me, I trade gold against the US dollar, and I always highly recommend, and I will always say this, for if you are a beginner or intermediate trader, go in and learn to master one pair. If you have 50 pairs on your screen, delete them. Here are an example of a few pairs: GBP USD. We have Euro USD. Note, USD doesn't exist, but we have so many others. USD JPY, blah blah blah. So USD CHF, all these other pairs. Focus on one pair. Learn to sit there and master and understand that one pair, because each pair reacts differently to certain things. Certain news events may affect a certain pair more drastically compared to another. So you have to know your pair. Trade one pair, stick with it, master it, become profitable with it, then go trade 50 other pairs. So that's the first thing you need to understand. Second, if you watch my trade recaps, you understand that I say bullish and bearish a lot within them. Bullish simply means going up, and bearish simply means going down. Us as traders, we like to use fancy words to make ourselves look cool. We're not that cool. As much as we like to say we're cool, we're not that cool. And we're not that smart either. That's why we take these words bullish and bearish and try to make them fancy. Bullish means going up, bearish means going down. Remember that. Now, getting into market structure. This is one of, I would say, if not the most important thing, understanding market structure, how market moves, how price action follows trend. We'll go into this mini diagram I made here of higher highs and higher lows. If you do know market structure, skip around like I said, but if you don't, stick around and I'm going to quickly explain it. So, within market structure, we always have points where we're going up and going down. We have what are called trends. Currently in this image, we have an uptrend, and in the image next to it, we have a downtrend. What are we doing within the uptrend? We're going up. Now, how do we know we're going up is the question. Well, we're creating a pattern, a higher high, higher low pattern. Why is it called that? Well, let's get into it. This is the lowest point of the high trend. Now, how do we know it's a high trend? Because we're creating a higher point. Higher high, higher low. Remember that. Higher high, higher low, higher high, higher low, higher high. Why is it called a higher high? Because this point is higher than the previous. Why is it called a higher low? Because this point is still higher than the lowest previous point of that uptrend. That's how you know you're going up. Remember, up, high, you're going higher, right? Higher high, higher lows. Same thing vice versa. Lower high, the overall low trend to the downside, down trend. Lower high, lower low, lower high, lower low, lower high, lower low. Why is this a lower high? Because this high is lower than the previous high. How do you know when market structure shifts? When this higher low gets taken out by what? Hopefully you got it. Bingo. This lower low. That's how you know price starts to make a shift in trend. We'll dabble into everything in the next few videos, but for now, I just want to introduce it to you. Now, going into higher highs and higher lows, you have to understand price action, and you have to understand what time frames to execute on. There are a multitude of time frames you can execute on. Personally, me, I execute on 1, 5, and 15. Those are my key time frames. I have gotten to the point where I can choose what time frame I want to execute on. You need to figure out what time frame works for you. There are two time frames. There's macro and micro. at which you can execute trades. Macro means the overall big picture of trend. What is the overall trend doing? When you look on the 1 hour time frame, 4 hour, daily, weekly, monthly, these are the bigger picture to where you can then see, okay, this is what we're doing on the big picture. Let me scale down to micro, the smaller time frames such as 1, 5, and 15, and execute there. So macro allows you to execute on micro. Macro always gives you a better understanding and better bias to what price action is trying to do. I hope you're following along, because the next thing we're going into is confluence. Confluence is simply, think of it as a checklist. We never enter trades with no higher probability or edge on our side. Remember, trading is a game of probabilities. As much as people would like to say it's gambling, it's not. It's a game of probabilities, statistics, and technical analysis. If you can execute on that properly, you can win time in and time out, again and again and again and again. It is more than possible. So with confluence, you need to make sure, you must make sure you have something, almost like a checklist, think of it if you're a beginner trader, that you mentally check off and look for before entering and taking a trade. We never take a trade just based off of one thing. We always take a trade off of a multitude of confluences, or even just 1 or 2 confluences. Personally, me, I use 2. You always want to make sure you have confluences. It is vital. It is so important, so important, so important. I cannot stress it enough. Make sure you have confluences, so you're not just entering trades blindly. Whatever those confluences may be, shoot, for you it may be Elon Musk sending a SpaceX shuttle into the sky. If that's your confluence, wait for that and execute when that happens. And if that's not your confluence, figure out where your confluence is and execute on that. If your confluence is a chocolate chip cookie flying through the air and blah blah blah, cool, that's your confluence. But make sure you have a confluence. So next thing I want to cover with you guys, apart from confluence and all that stuff, break a structure. For some of you have been in the markets for a very long time and still don't know what proper break of structure is. We're going to get into it. And I still don't understand how some of you have been in the markets for so long and don't understand proper break of structure. Don't worry. That's why Lonnie's here. Drew out a few examples. Remember, break a structure is when the body of the candlestick, this fat, thick part of the candlestick, crosses either upwards or downwards, above or below the previous high. Remember, high or low, so wherever it crosses. Or I'll say it in a single sentence, in a very, very simple sentence. Wherever the body of the candlestick closes. That's break a structure. There you go. Don't overcomplicate trading. Trading is not something that should be overcomplicated. Too many traders go in and overcomplicate it. Drawing a box on the screen and doing technical analysis is not hard. The psychological aspect's the hardest. That's why we're also going to get into that. Not in this video, but in the next, so stay tuned. And so with that being said, here, where do we break structure? Note, break a structure, I'm going to say it the third time because a lot of you don't understand this, is when the body, this white part of the candlestick, for my candlesticks, closes above a certain point. The wick, the skinny part, does not count as a break of structure. Where are we breaking structure to on this image? Hopefully you said to the upside. You're correct. What about here? Up, correct. What about here? Yes. What about here? Okay, still correct. What about here? Okay, now we're getting somewhere. Now, what about here? And this image right here, where are we breaking structure to? Right here. Hopefully you didn't say to the upside, because if you did, that would be incorrect. You lost a point. Now you're at a B. And if you did, good, you're at an A+. Keep following along. We actually broke structure to the downside. I never want you guys to think just because momentum starts pushing price up means we will break structure to the upside. That is not break a structure. Proper break a structure, if you need to know what it is, go on tradingview.com, go here, whatever this chart thingy is, and then go to line with markers. Every single dot you can see where the candle closes. That is where price broke structure. A wick is not a break a structure. Remember that. Remember that. A wick isn't break a structure. Now, we'll go more into depth about everything, like I said, later on in the series. But the next thing I want to dabble into, just speak about, is liquidity sweeps. What are liquidity sweeps? What is liquidity? Simply, liquidity, put as it is a pool of money located at a certain price point. And when price reaches a certain price point, there's either one or two things happen. People enter the market and or exit the market. Majority of the time, it's both. And let me explain why. Because the banks manipulate price action in a way to where they take retail traders like you and I out of the market so that they can enter the market. Why? It builds more liquidity. It builds more cash flow for them to basically take us out the market and then push price higher. So in this example, remember what I said about higher highs, higher lows, higher highs, higher lows, and then lower highs, lower lows, lower highs, lower lows. Remember what I said about that? What are we doing here? Higher high, higher low, higher high. Then what did we stop and do? No, we never broke below this low. So we're still continuing higher, but we did create a lower low. At this point, we created a lower low, taking out this liquidity resting below here, pushing price back to the upside. That is an example of a liquidity sweep. If you look at your chart, if you understand what a liquidity sweep is, you should be able to look at the chart and just spot them every single time. And I will show an example. But same thing here. Lower low, lower high, lower low, higher high, came up, took out liquidity, never broke past this previous high, then pushed price back to the downside. That is an example of a liquidity sweep. A perfect example is something like this. Price, lower low, lower low, lower high, lower low, and at this point, remember, this is a wick, but at one point, this candle was bullish. Everyone was thinking, oh, we're going to go up, we're going to go up, we're going to go up. Banks were like, nope, push price back to the downside. Everyone that placed a buy position off of momentum and not break a structure got taken out. Liquidity sweeped. And that's that. That's why it's so crucial that personally me within my trading strategy, I wait for break of structure, and I recommend a lot of people to wait for break of structure to actually get that full confirmation and confluence. So going into the next, order blocks. The reason why this is a perfect transition is because order blocks are formed when the liquidity sweep happens. The best and easiest way to explain an order block is the price range at which the move to the downside or upside that swept the liquidity was made. Look at the image. From this price point, 17.93, all the way to 17.65, this entire price range is where price swept liquidity. Then made the move to the upside. Typically, with what you'll see within the markets, price will sweep liquidity, create what is called the order block, and then after breaking structure to wherever price was following originally, it'll retrace, it'll come back and tap back into the order block to fill more orders. Why? Because remember, from this price range to this price range, banks were able to get their orders in. But, now after they do so, and they're like, oh, we didn't fill all of our orders, they push price back to the downside, filling more orders, continuing price up. That's an example of an uptrend order block. This is an example of a downtrend order block. Price coming up, taking out liquidity, creating an order block, retracing, bam, pushing back in, pushing price back to the downside. An example of this, I'll show you because I actually mapped it out funny enough, just for you guys because I care so much. You can see here, whoa. You could see here. What are we doing? What is this? Did you get it? I don't think you got it. Anyway, what is this? Higher high, bingo. At least you got that. Higher low. Higher high, higher low. You got me. It's a lower high and lower low. I was wrong. You're right. So at this point, we see we're in a downtrend. We know we're trending downwards. What did price do? It came up, created a lower high. Now what would we expect it to do? Create a lower low. Price was like, no. We're going to come up. We're going to take out liquidity, which is resting above this high right here, this 1961 high. Then push price to the downside, creating that lower low. Do you see it? It's almost like this bam, 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 bam. We were expecting to go lower here, but we didn't. This entire price movement from this wick all the way up here is the order block. From this price range, the lowest price range of 1950.23 all the way up to 1972.44, this entire price range is the order block at where we originally started moving price higher, taking out liquidity resting here, then making the move to the downside. And you can see, I don't make this up. I can't make this up. Price retraced. Remember, wicks stand for rejection. Price started rejecting in this order block, then continued pushing price downward. I could find a million examples for you. Another example right here. Right here. Price came up. We're going lower. Took out liquidity. Resting above here and here. 1937, 1936. Push price back to the downside. Price came up. What did it do right here? 1932. Came up, wicked, push price back to the downside. Like, I really cannot make this stuff up. Thing is, for me, I have sat here for around 6,000 times and analyzed this. You guys will have to go in and learn how to, do it. For me, it's muscle memory like that. I can go in and see them all the time. You will have to learn to do that. Now, finishing off with this, and this to me is the most important thing that a lot of traders get wrong, even intermediate traders. Having a valid stop loss. What is a stop loss? What does a take profit? We're going to get into that right now if you don't know what a stop loss or take profit is. A stop loss is simply an order position at which you can place to invalidate your trade. Meaning, let me say in a simple sentence, if price goes below this point, this is going to stop me from losing more money. As simple as that. It's as simple as it gets. It's going to stop me from losing more money. Stop loss. You got it? You got it? I hope you got it. Bam. You're following along. Take profit is the exact same thing, but opposite. When price reaches this point, I am going to exit the trade in a profit. Take profit. This will automatically take profit. Note, these are completely automatic. If it hits one of the two, good or bad. I mean, if it hits your stop loss, you'll probably go crying. If it hits your take profit, you'll probably start jumping in joy. That's what I do. I'm joking. Don't trade with emotion. It's horrible. So, you always, and I cannot stress this enough, want to make sure your stop loss is at a validating point in price action. I'm not going to go in on how to pair it with order blocks and liquidity sweeps and where to place a stop loss, even though a bunch of other YouTubers do that. But still, so many people, for some reason, tend to get it incorrect. I don't know how. Maybe they're not watching the full video. But whatever the case is, you need to place your stop loss at a validating point in price action. And if not, you will get stopped out every single time by a retracement, by price just coming back up or going back down just a little bit, then making the overall move. You don't want that. You do not want that. So typically, I would recommend placing them below. That's why I said higher highs, higher lows in the introduction, below these higher highs and higher low points. Typically after liquidity sweeps. You don't know how to pair that right now. Maybe you do. And if you do, good, do it. But if you don't, that's why I'm here to help. And so with that being said, if you are an intermediate trader, make sure you are entering these trades with a proper SL, a proper stop loss with whatever time frame you're trading. So many traders make this mistake, and it's such a frustrating mistake, because then they sit there and they're like, I have all this red on my P&L. I don't know what to do. I'm going to quit trading. No, don't quit trading. Your entries, something is off with your trading. Remember, if you get stopped out, that is your fault. That is not price action's fault. That is no one's fault besides your fault. You did something wrong within the markets. You can either sit there and mope and cry about it, or you can go in and be like, you know what? I'm actually going to succeed in these markets. I'm going to sit here and learn how to understand this and learn how to come back from your losses. So with that being said, this is an example of a bullish validating stop loss with take profit. Of course, in this example, we're targeting this high, nothing more, and our stop loss is below this low. Same thing, vice versa, if we're selling. Remember, consistency always wins. Just because your risk reward is a 1 to 20 on a trade does not mean you're going to hit it, and it does not mean it's a good trade. We are here to make our money and get out the markets. With what the market gives you, take it. Don't sit there and be greedy thinking, oh, I could have made another 20K. I could have made another $200. I could have made another $5,000. Forget it, bro. You didn't make it. Take your money with what the market gave you and go live life. That's the point, right? That's the point of trading. That's why we're all here doing it. As much as, we love the game, we're really here to make some bread. Let's be real. We're not going to sit here and just, for my free time, I just want to look at charts just for fun. Let's be real. We're trying to make something out of this. At the very least, if we're sitting there just looking at charts all day. But apart from that, those were the little key terms I wanted to cover in this first video. I want to make a mini series just going into psychology and everything that I struggled with as a trader that I have not seen other traders, even huge traders within the space, talk about, that I wish they would have. Because even me, I'm still learning, I'm still growing in my trading, and I'm so happy that you guys are following me on this journey, because that's what it is. It's a journey. We're all doing it together. So I hope you guys can continue to learn something from me. Comment down below what you want to see, what you are struggling with if you're an intermediate trader, or if you're a beginner trader, what you want to see in the future episodes and series and videos as we continue to dive in deeper into all of this. If you guys do have any questions, my Instagram handle is below. You can DM me on Instagram. I also have an inactive, not active, inactive Discord server, where if you want, you could join it and then DM me on Discord. And then, yeah, I can help you guys out if you guys need some help. Apart from that, I thank you guys for watching. I hope you guys enjoyed. Leave a like if you did enjoy, if you do want to see more content like this. And if not, leave a thumbs down. Shoot. Thumbs up, thumbs down. A like is a like, right? Like, dislike, same thing. Both words have like. But I actually love you guys. Thank you so much for watching. And I will see you guys in the next video. Maybe it'll be edited. I have not edited a video ever. But I love you guys. And I actually see you in the next one.